This is Al Brooks, and this is my price action trading course. The current module is on climaxes. I'm going through a list of common reversal patterns, and now we're at the end of the list, and that is climaxes. So what is a climax? It's any behavior that is probably unsustainable, and it's sometimes followed by a reversal. Most often it's followed by a correction that lasts for more bars and covers more points than what seems likely at the time that the reversal is beginning. Buy climaxes always end at resistance, like at a measured move target or at a trend channel line. Sell climaxes always end at support. So after a climax, why is the correction or the reversal so big? For example, after a buy climax, the rally ends once the bulls take substantial profits. Right? So if the bulls are taking substantial profits, what are they thinking? They would not have exited if they were planning on buying again just a few ticks lower or a few bars later. They're exiting because they're expecting a much lower pullback and many bars sideways to down and possibly 2 or 3 legs down. So the bulls are not looking to buy until the market has traded down for a lot of bars and a lot of points. So you don't have buyers down below. So there are not enough bulls to stop the bears from controlling the market. The market has to fall to a much lower price before the bulls will return. Not just a much lower price, they probably want to wait for 10 or 20 or more bars before they're looking to buy again. If they thought the market was just going to fall a few ticks and for a few bars, they would not have exited. They would have held on to their longs. You know, if you have a bull trend that has gone on for a long while, the bulls are not going to exit if they think the market's going to pull back just for a few ticks and then the trend will resume. You know, they're going to continue to hold. The only reason they'll take their profits is if they think they can buy back much lower, much later on. Climaxes in general are usually better described by some other term, like a wedge, a final flag, or a major trend reversal. V-bottoms and inverted V-tops do not exist. Every one is actually something else, usually a wedge or a final flag. Inverted V-tops and V-bottoms do not exist. All are some type of final flag. Sometimes the final flag is small, like a bar or two. Sometimes it's large. In this particular case, it's both. You have a series of consecutive buy climaxes, a large high 2, a trading range, a tight trading range, a big magnet, another buy climax, and then 3 small sideways bars, and then a final buy climax. And you can call it a V-top or an inverted V-top. To me, every top is some type of double top. Sometimes the first high is much lower down and it does not look like a double top, but every top is some kind of double top, and when the double top is not conspicuous, it usually means it's a small final flag. Sometimes the flag is just a single bar. Every bottom is some kind of double bottom, and again, it can sometimes be just a single bar occurring 4, 5, or 6 bars earlier. All V-bottoms are better described by some other term that I think captures the actual price action better. Every V-bottom is always some kind of double bottom, whether or not the first bottom is obvious. Here we have a small pair of dojis, so the market went down and up, and then down and up, so it's a small potential final flag. It's also an overshoot of a trend channel line and 3 pushes down, so it's a small wedge. So I would never describe a market as a V-bottom, because a V-bottom makes it sound as if the market went straight down with no pauses and then straight up. Markets don't reverse that way. They always reverse with some kind of pause or some kind of attempt at a double bottom. So to me, I would describe this as a small final flag, even though no bar went above the high of the prior bar. There was a sideways price action, a couple small bodies with tails, so there was some buying going on here, creating a small pause, and this small pause turned out to be the final flag, even though it's very atypical for a final flag. A climax is a trend, and it's made up of one or more trend bars. Remember, every trend bar is a climax. Every trend bar is a breakout. Every trend bar is a gap. Every series of trend bars is a climax. And depends on the context. Sometimes the series of trend bars will act as a breakout. Other times it'll act as a climax and the end of a trend. A climax can be very fast, composed of a series of very big trend bars, in which case it's often scary, or it can be very slow. Okay? The trend sometimes accelerates into an emotional parabolic curve. For example, a bear trend can get steeper and steeper and steeper and almost be in a free fall and then reverse up sharply. Remember, every trend bar is a climax. So a single trend bar that becomes a failed breakout is a climax. A series of unremarkable trend bars that just keeps growing, the series keeps adding new trend bars to it, that can also be a climax. It's unsustainable behavior. Whenever the market reverses from unsustainable behavior, it usually is followed by a TBTL correction. 10 bars, 2 legs. It can last more than 10 bars, but it usually has at least 2 legs. So that's my guideline when I'm looking for a reversal, whether it's a climactic reversal or any other kind of reversal. I'm always looking for a minimum of 10 bars and a minimum of 2 legs in the opposite direction. I think this is really interesting. This is the E-mini futures contract, and it's a weekly chart. And although you can't tell, this has a bull body, this has a bull body, and so does this. This area inside the red box is 10 consecutive bars with bull bodies. And that's never happened before in the history of the E-mini. So do you think that's sustainable behavior? No, it's climactic behavior. Even though the bars are not all large, it's still unsustainable behavior. And whenever the market does anything that's unsustainable, it usually has about 10 bars and 2 legs sideways to down. Here we had 3 legs down. It's possible that this is simply the first leg of a larger 2-legged correction, but this might be the end of the pullback. We might be channeling up, forming higher lows and higher highs. So this is extremely climactic, even though the bars are not big. It's extremely climactic because the E-mini has never had 10 consecutive bull bars on a weekly bar chart. So something that has never happened before is extremely unusual and unsustainable, and therefore climactic. Remember, every climax is always something else, and this is a higher high major trend reversal. We have a bull trend, a strong bear breakout, and a higher high major trend reversal. So it's a reasonable short there, or on the second entry below this strong bear reversal bar as well. Consecutive climaxes. Every trend bar and every series of trend bars is a climax. If you have a climax, let's say a sell climax, or 1 or 2 or 3 bars and then a pause, and then another sell climax and a pause, and another sell climax and a pause, without much of a pullback between the climaxes, you should expect 10 bars and 2 legs in the opposite direction. For example, each one of these red boxes is a sell climax, and here we've had 6 or 7 consecutive sell climaxes, and that is unsustainable behavior, and it's also developing a parabolic curve, which is also climactic. So the market probably will have a pretty good correction, at least 10 bars and at least 2 legs sideways to up. Parabolic curve, if you look at the trend channel line below the lows, they're becoming increasingly steep. We have a small double top at the bottom, forming a low 2 short, possible final flag, and then a 2-bar reversal at the bottom. So that's a reasonable buy for a test up at least to the moving average, and probably will get 10 bars and 2 legs. And this is what followed. We have the consecutive sell climaxes, a small double top bear flag, leading to the becoming a final flag reversal, another sell climax, and a 2-bar reversal. Minimum target is 10 bars, 2 legs, sideways to up. We have one push here, second push here. At this point, the market's clearly always in long, so I would not be looking to take profits, and I would not be looking to short. At this point, the market has become a strong bull breakout. I would be looking to buy. The minimum target is 10 bars, 2 legs. Here, we got much, much more. A climax occurs late. When you have a climax in the form of a late, strong breakout, it can be an exhaustion gap in the trend. So if you have a trend going on for 30 or more bars, so in other words late in the trend, and then you suddenly have one of the best looking trend bars breaking out to a stronger trend, that is a climax, and it usually attracts profit takers and counter trend traders. So if you have a very strong bull trend and then a sudden big bull trend bar closing on its high, or 2 or 3 strong bull bars closing on its high, the bulls will say, wow, what a great opportunity to exit at a wonderfully high price, and the bulls will sell out. The bears will say, wow, this is probably a buy climax, what a great place to short, and the bears will sell. So you got the bulls selling, you have the bears selling, the market's going to reverse, probably 10 bars, 2 legs down. So for example, let's say you have a bull trend that's going on for about 40 bars, and then now it suddenly has a big bull breakout, 1 or 2 strong bull trend bars closing near their highs. Okay? It could be the start of a new stronger leg up. More likely it'll attract sellers. The bulls will come in and say, well, what a gift, I'm going to sell out of my longs and only look to buy after 10 bars, 2 legs down. The bears will say, wow, this is too much, too far, too fast, what a great place to short. The bulls have a big open profit, and they're looking for a reason to exit, and when they get this gift of a surprisingly big final profit, they'll exit. They're not going to exit if they're thinking there's just going to be a small pullback that follows. They would continue to stay long. Remember, they've stayed long for 20 or 30 or 40 bars, and there were pullbacks along the way. If this is just going to be another small pullback, they're going to hold long. They're only exiting at the end of this strong bull breakout because they believe the market's going to pull back for a long time and for a lot of bars and for a lot of points. They won't look to buy again until the market falls at least 10 bars and 2 legs. The bears see it as a great opportunity to sell at an extremely high price, expecting a big correction. So here's an example. We have a bull trend. It goes on for about 30 or 40 bars, and now we have the best looking bull bar in the entire trend. So it could be a breakout that leads to a new leg up. It could also be an exhaustion gap. Remember, every trend bar is a gap. Here we got to close above the high of the prior bar. The bar afterwards, a low above the high of the prior bar. So there's clearly a gap. Whether this becomes a measuring gap or an exhaustion gap, we don't know. But there's not much follow through here, so the bulls are probably taking profits, and the bears are probably going short. The bears are, as a minimum target, they're looking for 10 bars, 2 legs, and they're looking for the market to go at least 1 tick below the low. The bears will short this close, they'll short below bars, and their original stop will be probably about a measured move up based on the height of the bar. They're 60% certain that the market will correct, so they can go for a profit target equal to their risk. If they're risking a measured move up, up to here, so if they enter here short and their stop is here, a reward equal to their risk is the bottom of this bar, and bears will take at least partial profits at the bottom of the bar over here in this area. You could also view this as a higher high major trend reversal. We have a bull trend, a trend line break, a breakout, and then a second entry short for the higher high major trend reversal. First entry, not all that strong, an II with the doji signal bar, but then we have a second entry, and that's a more reliable short. That's the end of my module on climaxes. This is Al Brooks, and this is my price action trading course. The current module is about measured moves and other types of support and resistance. Support and resistance. Support is a price below the market where buyers might be stronger than sellers, and resistance is a price above the market where sellers might be stronger than buyers. So why should we bother finding support and resistance, given that most of the time support or resistance will not stop a trend? It's because all reversals take place at support and resistance. So if you know where support and resistance is and you watch the market's behavior when it gets there, you're in a position to take a trade. You'll either look for a breakout or a reversal. So what's the big picture when it comes to trading? Well, two things. Most of the time traders are buying at support and selling at resistance. And then the other time that they're taking trades is during breakouts, strong trends. So for example, if the market's in a strong trend, it's racing towards some resistance level, traders will be buying the market in very tiny pullbacks, and they'll expect that every minor resistance level along the way will fail. The market might pause at resistance levels as bulls take partial profits, but the market will usually continue up through all resistance levels. Ultimately, when it does reverse, it'll be at a resistance level. But during a breakout phase of a bull trend, traders will be buying for any reason, and I talk about those in the module on trading a strong bull trend, a bull breakout. Similarly, with a bear breakout, traders will sell for any reason. The market is racing downward to a support level. You can't be sure which support level will eventually stop the market. However, you should assume that most support levels will not. The market may pause as bears take partial profits, but the market will usually continue through all the support levels. When it finally does reverse, it'll be at a support level. But during a bear breakout, traders will be shorting for every conceivable reason. Most of the time, the market is not in a breakout. Okay? Most of the time, it's either in a weak trend or a trading range. In either case, traders will be looking to buy at support and sell at resistance. So if the market's in a strong bull trend and it pulls back to test a breakout point, they'll buy. If it pulls back and tests a prior higher low, they'll buy. If it pulls back and tests the bottom of the bull channel or a trend line, they'll buy. If it's in a bear trend, let's say a broad bear trend, they'll sell rallies to the moving average, rallies to the bear trend line, the top of the channel, rallies to test a breakout point above. So if the market had a bear breakout below a bear flag or a trading range, they'll sell if it gets back up there again. If it rallies up and tests a prior lower high, they'll sell there. And most of the time, that's what traders will do. And how do you know this? They tell you. Just turn on television. Watch CNBC. Watch Fox Business News. When traders are talking about trades that they take, most of the time, they're simply buying at support and selling at resistance. If a stock comes out with an earnings report and the stock's in a bull trend and it has a big gap down, you won't hear the traders say, oh, I'm selling that. You'll hear some traders say, I'm selling that, and other traders saying, well, I don't know. It's down near the prior low, I'm going to buy. And you will virtually never hear them talk about candlestick patterns. Oh, a dark cloud cover. Oh, a Harami pattern, a hanging man. That's not how they're trading. Candle patterns are nice, but they're minor in importance. The big picture is support and resistance. And it's just really, really important to understand that and to use it as probably the cornerstone of your trading. You've got to be looking at support and resistance. It's far more important than candle patterns. A signal is made of both context and a signal bar. So a setup is made of context and a signal bar. The signal bar is the little candlestick pattern at the end. The context is what all the bars to the left show, and that includes mostly support and resistance. And it's far more important than the candlestick pattern. So for example, in a strong bull trend, a candlestick pattern is meaningless. You're going to buy for any reason. Even if there's a strong bear reversal bar, experienced traders will buy below the strong bear reversal bar, expecting the bar to be just trapping inexperienced bears into shorts. And the short will quickly turn into a bull flag. And smart bulls will enter exactly where those bears will have their stops and where they'll exit with losses. So big picture, support and resistance, and then 5% of the time when it's in a breakout mode, you enter for any reason in the direction of the breakout. The advantage of placing trades at support and resistance is that the trader's equation is very strong. The reward can be much bigger than the risk, and the probability is usually between 40 and 60%, and that creates a very strong positive equation, trader's equation. What types of support and resistance are most useful? Trend lines, prior highs and lows, and measured move projections. So for example, if the market's in a bear trend and you draw a trend line across the highs, you look for the market to test the trend line, and if you get a strong bear reversal bar, you have a strong setup for a short. Your risk is small, the height of the signal bar, and your reward is large, probably at least twice as much as what you are risking. Here are examples of other reversals. Again, a trend channel line. The market broke below it and immediately reversed up. Here's a bull trend, and we have 3 pushes down. The market fell below the trend channel line and reversed up. So you have a wedge bull flag after a very strong breakout. So it's a higher low major trend reversal at a trend channel line. Here we have a double top. You can call it a wedge, you can call it a triangle, and it's at the top of a trading range. The market poked out of the top and then reversed down. And again, a bull channel, now at the bottom of a trading range, so near a prior low, so you have a large double bottom, and the market poked below the trend channel line and is reversing up. So small risk, you enter 1 tick above the high of the bar, you stop as 1 tick below the low of the bar, and your target is somewhere around the top of the trading range, and that's several times bigger than the amount that you're risking, yet the probability is at least 40%. I say that because probability for most trades is 40 to 60%, and if you're not certain, assume that it's 40%. If you're very, very confident, assume that it's 60%. Prior highs and lows are support and resistance. So we have a high here. The market went a little bit above it and then reversed down in a strong bear reversal bar, creating a double top. A prior low here. The market touched it but broke through. However, when we got down to another low just a little bit lower, we got a big tail. We tried to push down again and got a tail. We tried to push down again and we got a tail, and this time we have a strong bull reversal bar. So the market is reversing at support just below this low and just above that low. So that provides a good entry for a trade where the reward is bigger than the risk. Probability maybe 50-50 in a situation like that. Here's a more complete list of support and resistance, trend lines, prior highs and lows, measured move projections, moving averages on any time frame, and then a bull entry bar low and a bear entry bar high, a bull signal bar high and a bear signal bar low, the high, low, open, and close from today, yesterday, on the daily chart, the weekly chart, monthly chart, daily pivot points, I never look at them. Fibonacci retracement levels and projections, I never look at them. And any type of band, Bollinger Band, Keltner Band, I never pay attention to them either. You can make trades off these things even though I don't pay attention to them. But I think the other types of support and resistance are much more reliable, and they provide me with enough signals that I don't have to look to less reliable support and resistance. Here's an example of a strong bull trend, and the moving average is support. I use a 20 bar exponential moving average. We have a strong bear bar trying to reverse the trend. It hit the moving average, and we immediately got a bull inside bar. So that is a good high 2 pullback at the moving average and a strong bull trend. 1 push down, 2 pushes down. So you can call it an ABC pattern. You can call it a high 2 buy setup. In any case, it's a strong buy signal and a strong bull trend at a support level. prior bear signal lows, okay, we have a sell signal, a bear signal bar here, we have a bear signal bar here, and a bull trend, and the bull trend keeps going up. Eventually, the market reverses. This is a parabolic buy climax at the top of a spike and channel pattern, spike and channel, and then we have a lower high major trend reversal. Targets on the downside are failed sell signals below. So the market tried to reverse here. The market will probably come back and test it. It did here. It did again here. Here's another possible sell signal for a higher high at the top of a trading range. The market trapped bears in and went up. Bears will short here. They'll scale in higher. They'll add on here. They'll add on here. And they'll hold until the market gets back down to their original signal. Once it's in the area of their original signal, they buy back all of their shorts. They take profits on the shorts from here, they take profits on the shorts from here, and they get out at break even here. So the market is drawn down to this price level, and the bears are not going to buy back their shorts until it gets here, and that's what happened here. We got back to the low of the earliest sell signal, and the market found buyers. Bears bought back their shorts to take profits, and you had some aggressive bull scalpers buying for a scalp. Okay, a bear signal bar low. So we have an IOI top to this spike and channel pattern, possible sell signal. We sold off, and then we got drawn back up to test the original entry price, the low of the signal bar. So that is a magnet. It's a resistance level, and you can see the market created a 2-bar reversal here. So it's a short, 1 tick below the bear bar. It's also a wedge bull flag, 3 pushes up, 1, 2, 3, or you could use maybe this high, 1, 2, 3, and it's a good looking sell signal for at least a test down to the bottom of the range. And possibly a second leg down, and a leg 1 equals leg 2 bear trend. Most measured moves that I use are based on spikes. You can use the term breakout, you can use the term trend bars, it doesn't matter, all the same thing. So most measured moves are based upon breakouts and on trading ranges. In other words, strong trends and trading ranges. Measured moves are most useful for profit taking. Remember, most support and resistance fails to stop a trend. However, it's a good area for taking profits if you're holding a position in the direction of the trend. If the context is good, you can look for a reversal trade at a support or resistance level, for example, one based upon a measured move. Remember, the market's always alternating between a trend phase and a trading range phase. When a measured move is based upon a spike, a breakout, it usually leads to a trading range. When a measured move is based on a trading range, it usually leads to a breakout, a spike. If there's a trading range, look for a measured move up or down after the market breaks out, and you base the measured move projection on the height of the trading range. And you look to take partial or full profits once the measured move reaches once the breakout reaches the measured move projection. Here's an example. We have a bear trend, we have a trading range, and the market could break out up or down. Here it started to break to the downside. If you went short anywhere in here, for example, at the top of this ABC, 2 legs up, 1, 2, so it's a large low 2 short and a bear trend. If you took that short, you're going to be taking profits at some point. One area where you might want to take profits is at a measured move down from the height of the range. So here's the top of the range, the bottom of the range, here's the measured move projection, and look what happened when the market got there. We had a little reversal, and that tells you that a lot of traders took profits there. It doesn't matter if they shorted up here, if they shorted the failed breakout of this micro channel, or if they shorted here on this small wedge bear flag. 3 pushes up, 1, 2, and 3. It doesn't matter where they shorted, they'll probably take partial profits based upon a measured move created from the trading range. And you can see they took partial profits. They didn't buy everything back. We got a little bounce, and then the bear resumed. If the breakout keeps going after hitting a measured move target, then look for a measured move based upon the height of the spike, on the height of the breakout. And then you take more partial or even full profits at measured move projections. So here's an example. We have the market just kept going. If the trend continues, you take more profits at projections based on the height of spikes. So for example, we have a trend down, a leg 1, a trading range, and then trend resumption. So traders will look for the market to possibly reverse once it reaches the length of the first leg. So here's the first leg. Here's exactly the same number of ticks. And look what happened when the market got down to the measured move based on a leg 1 equals a leg 2 projection. Again, you have a small reversal, so traders obviously took profits here. Partial profits, full profits. Different traders do different things. Also, you can make a measured move based upon the height of this breakout attempt, right? So here's how high this original bear spike was, and you can project down from below its low, and it takes you to this price level. And again, traders will use that as an area where they'll take profits on their shorts. Here's another example of a leg 1 equals leg 2 move. There are actually two in this picture. So leg 1 here is A to B. The market pulled back to C, a higher low major trend reversal. And when it reached a move up equal to the height of AB, in other words, when CD became the same size as AB, traders took profits, and this is what happened. Now we have a larger pattern. We have a leg up from A to D, and when the market sold off to E, and then the trend resumed up again, traders will look for a measured move equal to the height of A to D. And that's what happened up here. You see profit takers on the leg 1 equals leg 2 measured move up. So what ultimately happened was we had a larger leg 1, leg 2 move. The larger leg 1 is A to D. It's subdivided into two smaller legs. And then the second leg up, E to F, also subdivided into two smaller moves. The middle of a trading range often provides a way to create a measured move projection. Remember, a trading range is an area of agreement. The bulls agree that it's a good place for putting on longs. The bears agree that it's a good place to put on shorts. So it's probably the middle of something. It's probably the middle of the value for both the bulls and the bears. So if it's the middle of something, it can lead to a projection, a measured move projection. Here, the market rallied sharply from 1 to 2, and then it entered a trading range. The trading range might be the middle of the move. So if you look at the middle of the trading range, you can use that to project up to where the move might go, and traders will then consider the move has gone too far. Okay, so you get the low here, the middle of the move, and you project up here, and you can see what happened when the market got equally high above the middle of the trading range. It started to find sellers. Some of the sellers were profit takers, and some of them were shorts. And obviously there were a lot of shorts because the market came back down into the middle of the trading range. Okay, so a trading range is an area of agreement, so it might be the middle of a bigger move. Here the market sold off and then went sideways. So you have to wonder, trading range, traders agree that this is probably a reasonable price, so it's probably the middle of value. Both the bulls and the bears like this area. Both the bulls are buying and the bears are selling. That's why we're going sideways. So it might end up being the middle of the entire move. So traders can project down from the top of the move to the middle of the trading range and then find where a measured move down would be, and bears will look to take profits in that area. here on the upside, we have a pretty strong move up, and then two-sided trading. So both the bulls and the bears think of this as value. So if it's an area of value, it's probably in the middle of the developing trend, and you can project up, and traders will use that as an area for taking profits. The height of the spike, in other words, the height of the breakout, often leads to a measured move projection. So here we have a very strong bear breakout. You could say the breakout continued all the way down to here or all the way down to here. It doesn't matter. But when you have a 2 or 3 or even 1, 2, 3, 4 consecutive very strong trend bars, traders will look at the open of the first bar to the close of the last bar and project down, and that's an area where they'll look to take profits. And that's what happened when the market reached the measured move projection. The bears took profits, aggressive bulls started to scale into longs for a scalp up. Here's a strong bull spike. You can use the open of this bar to the close of this bar, the open of this bar to the close of that bar, the low of the spike to the top of the spike, the open of the spike to the top of the spike. No one knows in advance what traders will use for measured move projections, and I tend to look at all the possibilities. And measured move projections based on spikes can go either direction, up or down. So here's a bull spike, and the market started to reverse. So when the market started to form these two bear bars, you had to wonder that it might break out below the low of the spike and then go down for a measured move, which is what it did. There's something interesting about this measured move. I said use the open of the spike. This is also the open of the day, and this is a fairly common situation where you have an open of the day, and then the market goes up for about half of an average daily range. It then reverses through the low of the day, and it very often then finds support at exactly a measured move in the opposite direction. So we had the open, it traded up for about half of an average daily range, and then it started to reverse. When it's starting to do this, traders expect it to trade down for about the same number of ticks, and for the open of the day to end up as the exact middle of the day, creating a perfect doji bar on the daily charts. So traders will look to take profits down here, and aggressive bulls will even buy, looking for the market to come back to the open of the day and possibly form a perfect doji bar on the daily chart. Instead, on this particular day, we had a double bottom bull flag here for a higher low major trend reversal and a reversal up toward the high of the day. On the daily chart, this will be a reversal day. Here's the open, then a tail on the bottom, and then a close on the high. So the point, again, the open of the day sometimes is the middle of the day, and traders look for measured moves based upon the first move. Here's a strong bear spike, so you always look at the open of the spike to the close of the bar, and you look for a measured move up or down. Here's the measured move up, and look what happened. Okay, the market broke above the high of the bar and raced up and went a tick or so above the high of the bar and found sellers. Who's selling? Well, the traders who bought down here will look to take profits at measured move projections, and it turns out that today they took profits at a measured move based upon the height of the bear body, the height of the bear spike. And you probably had other traders shorting as well. Here we have a bull spike. Here's the open of the spike. Here's the top of the spike. I could have also used the open of the spike to the close of the final bar of the spike to generate a measured move projection. You can also generate a measured move projection based on the height of the trading range. Here's the bottom of the trading range. Here's the top of the trading range. And here's the measured move projection down. And traders will use measured move projections to take profits. And that's what happened here. So when the market reached the two measured move projections, you had a lot of buying. Most of the buying was probably mostly bears taking profits, and the market went sideways a little bit, and then the bears came back. And they reached this point and reversed up, a lower high major trend reversal, bear trend. Here's the trend line, here's the trend line break. Even though it did not reach the moving average, there was a lot of sideways trading with a lot of bull bars, so that's enough buying pressure for traders to look for a reversal. Once the market started to reverse up, traders will look for areas to take profits. One thing that they'll do is look for a measured move based upon the height of this trading range, and that's what happened up here. Bears will might scalp shorts. Bulls certainly will look for areas to take profits, and this is a logical place for them to take profits. It's also a test of the original breakout point in the sell-off back here. Here's the breakout point, and here's the breakout, and the market came back to test that area. Micro gaps. Every trend bar is, and for every trend bar, you always look at the bar before it and the bar after it. And if those two bars do not overlap, you have a micro gap. The trend bar is a micro gap. And it's a sign of pressure. If it's a bull trend bar, it's buying pressure. If it's a bear trend bar, it's selling pressure. And it increases the chances that there'll be follow through in the direction of that trend bar. So for example, we have a bear breakout and the bar before it, and you can look at the bar after it, or even the bar over here. We have a micro gap. The bulls were unable to push the market back above the breakout point, the low of the bar before the trend bar. That's a sign of selling pressure, and it increases the chances that there'll be further downside movement. Okay, we have some highs here, and then we have a little breakout bar, and the pullback did not fall below the breakout point. So that's a sign of buying pressure, urgency on the part of the bulls. You'd expect higher prices. We have a big bear breakout here. Here's the breakout point, and the market did not come anywhere near the breakout point on its pullback. So a sign of tremendous urgency, a lot of selling pressure, and the market probably will go lower. A gap here. Here's the breakout point. Here's the bear breakout. The pullback did not go above the breakout point, so we have a micro gap in here, and it's a sign of strong selling, and you expect lower prices. Here's a bull breakout, the close above the high of the prior bar. The next couple of bars tried to come back and test, but they could not fall below the breakout point, a sign of buying pressure, and it increases the chances that the market will go up. If the gap fills, the chance of follow-through is less likely. So for example, here's a bear breakout, here's the breakout point, but this rally went above the high of the breakout point, and that reduces the chances that the market will go down much further. Each of these red lines is other examples of that. Here's a bull reversal bar. The market had a strong bull trend bar here, it closed well above the highs of these bars, but the next bar, instead of staying above the highs of these bars, quickly reversed down below the highs of those bars. So the micro gap immediately closed. This trend bar basically is an exhaustion gap on the part of the bulls. It's a one-bar bull trend. Okay, bull breakout, closed above the high of the prior bar, but the next bar did not hold above the high of this bar. The micro gap closed, and the market fell. Bear breakout, and here's the gap, the low of this bar, the high of this bar. We have a micro gap, but it closed and it became an exhaustion gap, and the market went up instead of down. Here we have a trading range and a gap up, so we have a large gap, and a lot of times the middle of a gap leads to a measured move. So here's the start of the move, here's the middle of the gap, and if you project up for the measured move, we eventually got there at bar number 9. Okay, we have the markets trading down to this point, and then rallied, and then broke below 0.2 over here. So potential measuring gap, and the high of this bar stayed below the low of that bar. This pullback stayed below the low of that bar. So and then the market started to turn down again. So that left us with a gap below the low of this bar, above the high of this bar. The middle of that gap might be source for a measured move projection. Here's the start of the move, here's the middle of the gap, and traders will look to take profits at the bottom of the measured move projection. Aggressive bulls might buy, especially given this strong bull bar. At this point, they would only be buying for a scalp. Here we go, a bear trend. The market broke out below point number 2. It pulled back at 4 and 6 into a double top bear flag and started to turn down. So that left us with a gap, this gray box. You can look at the middle of the gap and the start of the move to create a measured move projection down. And the market fell a little bit below it and then reversed up. So traders took profits here, and we had pretty good buying pressure. And that tells you that probably bulls were buying as well. And that's what we can tell certainly from the strong reversal up. So traders take profits at measured move targets, and you also have traders taking positions in the opposite direction. There are often many possibilities for measured move projections. Here we have a reversal up. Here we have a strong reversal up in the spider. So the market may go for a measured move projection based on the height of the sell-off. So traders will make a projection up and look to take profits in that area. We have a very strong bull spike, and strong bull spikes usually lead to measured move projections. The spike became very strong at the start of this bar, and it continued up through this bar, so traders will be looking to create measured move projections based upon that spike. Maybe from the open of the spike to the close of the third bar of the spike, maybe the bottom of the spike to the top of the spike, maybe from the bottom of the leg up to the top of the leg up. All of those projections come out in the same general area. Whenever there's a confluence of resistance levels in the same area, it becomes more likely that the market will turn down at that price level, because different firms will use different projections, and if a lot of firms all have projections in the same area and they all start doing the same thing, taking profits or taking trades in the opposite direction, it increases the chances that the trend will reverse. And you can see that when we got up to this general price area, the bulls took profits and the bears went short. On the way down, we're trending down, and then we had a breakout bar late in the trend. This is a breakout bar, and it turned out to be a 2-bar reversal. So traders are wondering, is it the end of the move? Is it a sell climax? Or will the gap stay open and become a measuring gap? At this point, we had a pullback that tested the low, and then the market started to turn down again, so traders began to think that this might be a measuring gap for a measured move down, maybe based from the height of this leg, or maybe based on the height of the entire move down. Traders will look at both. The market sold off to this point and then turned up here, but look what happened. It did not close the gap. So that increases the chances that this is a measuring gap. We have a 2-bar reversal on the test of the gap. Traders will also short below here. So they shorted below this bear bar after it turned down after testing the breakout point, and they'll short again here below this 2-bar reversal on the test of the breakout point. And the market reached the measured move projection at the end of the day. E-mini, we have a gap up, a very strong breakout. Here's the bottom of the gap, here's the top of the gap, and this is the middle of the gap, so look for a measured move up. And the market turned exactly at the middle of the gap. We have a bear leg that started here with this bear spike and a gap between the pullback and the breakout point, and the market in this case went well below a measured move down. And that is the end of the module on measured moves and other types of support and resistance. This is Al Brooks, and this is my price action trading course. The current module is about probability and the trader's equation. Edges in trading are fleeting and small, and you need an edge. You need a mathematical advantage if you're going to be profitable. This is basically a zero-sum game. You pay a little bit in commissions, but it's essentially a zero-sum game. And you're trying to take money from very smart people. And all trading is subjective and hard, so it's impossible to have a big edge. The best you can hope for is a small edge, and even then it probably will not last long. So when you have it, you have to take action. High-frequency trading firms, HFTs, use algorithms sometimes for days at a time, maybe weeks at a time, and then they decide that those algorithms are no longer as profitable as they were when they first started using them a few weeks ago, and they stop using them and switch to other algorithms. So even high-frequency trading firms are not using algorithms forever. They realize that their edges are small and don't last long, and once they stop being as profitable as they once were and other algorithms appear to be more profitable, they switch. Holy grails cannot last because there has to be someone taking the opposite side of the trade. There has to be an institution taking the opposite side of the trade. And if you're constantly making money, they're not going to constantly lose money. They're going to do something different. So your edge will disappear. Just think about it. If you did have a goose that was laying golden eggs, a holy grail, some kind of pattern that was consistently generating huge profits, it could not happen. If you had one, you'd have smart people on the other side of the trade realizing that they're giving you money constantly, and they would stop doing it. There would be nobody to take the other side of the trade. In fact, people would discover what you're doing, and the algorithms would start doing what you're doing. And if everybody starts to do what you're doing, there's no one left to take the other side of the trade, and the trade would no longer work. So perfect trades, holy grails, cannot exist. Every trade is based upon the trader's equation, which is based upon the question, will I probably make money on this trade? You ask yourself that before you take any trade. And how do you know what the probability is? You can use computer testing, the way the high-frequency trading firms do. You can use years of personal experience. Both are valid. Everyone, at least subconsciously, only takes a trade if the chance of success times the reward is significantly greater than the chance of failure times the risk. All right? So that's a mathematical formula, an equation, and it's the trader's equation. So it's the probability of success times the reward. It has to be significantly greater than the probability of failure times the risk. And if that is the case, you have a valid setup, a mathematically sound, a mathematically correct situation, and the trade is worth taking. There are three variables in the equation. You always hear on television people talking about risk-reward ratios. Implicit in that is the probability is greater than 50%. So if a trader on television says, wow, this is a great risk-reward ratio, I would take this trade, they're also incorporating probability into their formulation. What they're saying is the probability is high enough so that they'll make money on the trade, and they're particularly attracted to the trade because the reward is so much bigger than the risk. But again, you always have to factor in probability, which is probably the most important variable because it's the only one you cannot control. You can control your risk. It's how far away you put your stop. You can control your reward. It's where you put your profit-taking limit order. The one thing you cannot control is the probability, and that is probably the most difficult thing for traders starting out. They are very uncertain with probability, and it takes a long time to realize that everything you do in trading is uncertain. You're never going to be certain of anything. And if you are certain of a trade, don't take the trade because you have to be wrong. Because there would be no one to take the other side of the trade. If a trade was 100% certain, everyone would see it as certain and nobody would take the opposite side. Again, you know the risk and reward because you set them when you place your bracket order.
Your bracket order is two orders. It's a profit-taking order, and profit-taking limit order, and a stop order. You know how far they are from your entry price, so you always know the risk and reward. The risk, number of ticks to your stop. The reward, the number of ticks to the location of your limit order for taking profits. Probability, it's the most important variable, and it's the reason why trading is so hard to do well, and management is the key to success. Probability, it makes beginners not take potentially great trades because the probability is just not high enough, and it also causes beginners to exit strong trades too early. They'll have a huge, very strong major trend reversal bottom, for example, and as soon as the market starts up, they'll say, oh boy, I made a point, and they take their profit, and then the move continues up for 10 or 15 more points because they refuse to accept that the probability was on their side. Probability is the source of all emotion in trading because it's the one variable you cannot control. Risk doesn't cause emotion, reward doesn't cause emotion because you control them, you set them. Probability is what causes emotion. Computers have no emotion, right? And you can only make money if you follow what the institutions are doing, and since the computers are trading 75% of the market, you can only make money if you follow what the computers are doing, and they are not using emotion to generate trade ideas. Emotion creates losers. You will lose until you can be free of your emotion, and you cannot win until you're comfortable with constant uncertainty. Right? We swim in a sea of uncertainty as traders, and you have to be comfortable in that environment before you can make money. Again, probability can never be known with certainty. However, you can make assumptions that can help reduce a lot of the stress involved in trading. In general, give yourself just two choices. Either the market's 60-40 or 50-50. If you cannot tell what's going on, in other words, you look at the market and say, well, I don't know, it could go up, it could go down, then it's 50-50. So use 50% as the probability in your trader's equation. Then, if you're going to take a 50-50 trade, you need a reward at least twice as big as your risk to make the trade worthwhile. So if you know your risk has to be 2 points, right, and you think the probability is 50-50, I don't know if it's going to work, then you need a reward twice as big, 4 points. If you're taking a scalp and a strong bull trend, you're pretty sure it's going to work. So the probability is 60%. And to have a positive trader's equation, the reward has to be only as big as the risk. So if you have a 2-point stop, all you have to do is go for a 2-point profit to have the trade be worthwhile. If you're looking at a trade and say, I don't think this is going to work, but it's a major trend reversal, and if it does work, the reward can be very large. The minimum that you need for the reward to have a positive trader's equation is 2 times the risk. So if you're taking a major trend reversal and it doesn't look all that good, but it still makes sense because it's a major trend reversal, assume 40% probability, but you have to go for a reward that's at least twice your risk. So when it comes to probability, if you really can't tell what's going on, set the probability at 50% and then determine how much reward you need given the risk that you face. And then the other choice is it's either 60 or 40. So it's either a 50-50 trade or it's a 60-40 trade. And if it's a 60% trade, you can exit with a reward equal to your risk. If it's a 40% trade, you can exit with a reward 2 or 3 or 4 times your risk. Since you cannot know for certain what the probability is, you have to make assumptions. And you can use your personal feelings to give you an idea of what assumptions you should make. You're either going to assume 60-40 or you're going to assume 50-50. If you look at a trade and say, yeah, I think that's a pretty good setup, I think it probably will work, then assume that your probability is 60%. It might be much higher, but it has to be at least 60% for you to be able to look at it and say, yeah, that looks good. For example, a low too short and a very strong bear trend, you look at it and you say, yeah, that probably will be successful. Then assume that your probability is 60%. If you look at a trade and you can't tell, I don't know if this will work, I don't know if it won't work, I don't know if it will work, assume that your probability is 50%, and then you need a reward at least twice as large as your risk. If you look at a trade that you think, this doesn't look all that good, but the reward is so much bigger than the risk, I think it might have a positive trader's equation. Assume the probability is 40%, and you only take the trade if the reward is several times bigger than the risk. The probability is never going to be less than 40%, and it's never going to be more than 60%, because there has to be an institution that will take the other side of a trade. So if the probability is only 10%, there's no institution is going to take the other side of the trade with a 90% certainty of losing. So the market lives in a band between 40 and 60% probability most of the time, like 99% of the time. Again, you can't control probability, and you're either confident, which is certain, and that means probability of 60% or more, or you're not sure, you're uncertain, it's confusing, in which case the probability is 40 to 50%. Traders, we swim in a sea of constant uncertainty. I mentioned that. And clarity exists for only brief moments, like during very strong breakouts. And most of the trading is pretty unclear, and the probability is rarely more than 60%. And you don't have to worry about that. If it looks that certain, just assume that it's 60%. When traders are trading and they're starting out, they're always wondering what's to the right of the current bar. What will the next bar look like? The next 5 bars, the next 10, the next 20 bars, the next 30 bars. And you really can't tell, right? You don't know. You don't know until you actually see them. And that's that uncertainty factor. The traders are always living with uncertainty. But however, you can get an idea of what will happen by simply looking to the left of the current bar. Markets have inertia, and they tend to keep doing what they have been doing. So if they've been in a trend, they'll probably continue to trend. If they've been in a trading range, they'll probably continue in a trading range. If they're starting to break out, they'll probably continue to break out. If the breakout looks weak, it probably will fail. So you just look at what's to the left, and that is your indication of what is most likely to be to the right. Beginners are always looking for guarantees and perfect trades. Tell me how to trade. Give me a pattern that works all the time. Tell me how I can make money. And they don't realize that guarantees don't exist, perfect trades don't exist. You just have to accept the reality that you live in a 40 to 60% probability world, and you're going to be wrong 40 to 60% of the time, and you're going to be right 40 to 60% of the time. Extremely good traders are going to be right more. Beginners who mismanage trades are going to be right less, but most trades are going to be between 40 to 60% certain. I mentioned that the market's rarely more than 60% certain. Well, in fact, you as a trader all the time believe correctly that the market is 90% certain. For example, if you buy a strong bull trend and the market goes up, and hits your profit-taking limit order, but does not fill it. In other words, it needs to go one tick higher. At that instant, when it hit your order and did not fill it, you still have a stop below, and your stop might be 6 ticks below. So at that instant, while you're waiting for your limit order to get filled by the market going one tick higher, you're holding on to a trade where you need the market to go one tick higher, yet you're willing to risk 6 ticks to make that bet. And you can only make that bet if you're 90% certain or better. So every day, every time you take a profitable trade, at some point during the trade, at least briefly, you're 90% confident of your trade. Otherwise, you would exit because there's mathematically no other way that you could continue to hold that trade with a risk that's 6 times or more greater than your reward. It does not make sense to hold the trade unless you are extremely confident of making a profit. And in fact, you are correct. at that instant you probably are 90% certain, correctly 90% certain that the market will go that one extra tick before it goes 6 or 7 or 8 ticks in the opposite direction. Okay, this is just what I was saying. You would only hold on to that position if you were actually 90% certain. Otherwise, you'd have a losing trader's equation, and it would be irrational for you to hold on to a trade that has a losing trader's equation, because you would lose money. The cardinal rule of trading: you always want a reward at least as large as your risk. So if you're risking 50 cents in IBM, you have to go for a reward at least as great as your risk. In other words, at least 50 cents. Because otherwise, if the risk is greater than the reward, you have to be right 70% of the time just to break even. And you can't be trading to break even. You have to be trading to make money. Most of the best traders cannot be right 70% of the time, day after day, year after year. So you should not be going for a risk greater than the reward, because that requires you to be right 70% of the time, and that's something that most great traders cannot do. 60-40 rule: nothing works all of the time, everything works some of the time, most things work 40 to 60% of the time. So this is the assumption that you should make with every setup. The probability is somewhere between 40 and 60%. Whenever someone says he has a higher probability, he's being dishonest. He's selling you something. Every now and then you'll see someone on Fast Money say that, oh, the market's going up. Gold is going way, way, way up. Right? Whenever somebody says that, they're either dishonest or stupid, because they're assuming the probability is far greater than 60%, and they cannot be that certain, because if the probability was 90%, the market would immediately get up to that price target. Right? The only reason the market is not up to where they say it's going to go is that the probability is not nearly as high as they're making it sound. Perfect trades cannot exist, because everyone would jump on them and there would be no one left to take the other side of the trade. Okay, remember, institutions are the market. 95% of every market is institutional, right? And at every given instance, there's a bull buying and a bear firm selling, and both presumably are profitable. So, how can they both win? Because there's a valid bull and bear case at every moment of the day. Okay, remember, both the bulls and the bears have a 40% chance of making a profitable trade, because all setups are between 40% profitable. And they also have a 40 to 60% chance of losing, even with a great setup. Everything is between 40 and 60%. Okay, can both the bulls and bears be right? In other words, at any given instant, both the bulls and the bears are taking positions, and they would not take the positions if they had not done testing proving that they have positive traders' equations. So how can it possibly be that the bulls are buying at this minute and the bears are selling at this minute, and they both have positive traders' equations? It's because of the 40 to 60 rule, 40 to 60 rule. And remember, for a swing trade, you only have to be right 40 to 50% of the time, right? And therefore, the other side is probably 40 to 50% chance of success as well. So if a bull has a 50% chance of success, he has a 50% chance of failure. That means the person taking the other side of his trade has a 50% chance of success, right? So both sides will have between a 40 to 60% chance of success on every instant during the day, and if they manage their trades correctly, both can be profitable. If they take the 40% side, they need to reward twice their risk. If they take a 50% side, they need probably twice the risk as well. But if they take a 60% trade, they only need a reward equal to their risk. Also, institutions will scale in as the market goes against them, and that increases their probability. What's a good trader's equation? Since a swing trade requires a reward at least twice the risk, both the bulls and bears can lose more than 50% of the time and still make money. Okay, take a look at this market. We have a bear channel, a bull breakout, and we have a higher low major trend reversal. So it's a good setup for the bulls. Is it 60% certain that they'll make a reward twice the size of their risk? I don't know. Most major trend reversals are more like 50%, some are 40%. I would assume this is more 50-50. But anyway, it's a decent major trend reversal setup for the bulls, a higher low major trend reversal. So that's a good swing trade for the bulls. Now look what happened. Here's the bear argument. Okay, we have a bear trend, and we have a rally, but most reversal attempts fail. Here's a reversal attempt. Most reversal attempts fail. And what they're doing is saying, yeah, it's a higher low major trend reversal, but it's hitting the bear trend line, and it's forming a bear reversal bar. That's a good short in a bear trend. We're also in a trading range, maybe in the top half of the range, I don't know. But we're at a bear trend line in a bear trend, so it's a reasonable short. So the bulls bought here for a swing long, 50-50 bet. The bears are shorting here for a test of the trend line and a bear trend for a 50-50 bet. And both have valid arguments. If you look to the left, you can see that we've been in a trading range for the past 30 or 40 bars. And whenever the market's in a trading range, there are bull cases and bear cases. Both are valid. A hugely positive trader's equation. You need a very high probability of making a very big reward while having a very small risk. In other words, a perfect trade, right? You have a high probability of making a whole bunch of money while risking very little. That's the perfect trade. Again, it cannot exist because there has to be an institution to take the other side of the trade. And no firm would take the opposite, which would be a low probability of making only a small reward while having a big risk, right? No firm is going to do that. And therefore, a perfect trade cannot exist. So beginners looking for perfect trades will never find them. They'll find plenty of people who will sell them books and programs that guarantee perfect results, but they're all frauds. Any trade that comes close to perfection would be quickly jumped on by many institutions. So let's say we have a perfect buy setup, right? And everyone looks at it and say, wow, that's perfect. What would happen is everyone would buy, and you'd get a huge bull trend bar. The stop of any long up there would be below the bottom of the bar, so the risk would be huge, right? And there probably would not be much left to the move because everyone knows the market was going up, and we just went up, and the probability is less. So as soon as everyone decided it's perfect, you'd get the huge bull trend bar. That greatly increases the risk, significantly reduces the reward, and also reduces the probability. So the perfect trade no longer exists. Trading is always going to be difficult. Nobody's going to give you money. The trader's equation is never going to be very positive. Your edge, your mathematical advantage, is always going to be small. There are problems that makes it difficult to trade every type of a market. A trading range, a strong breakout, or a channel. Remember, the market's in a constant cycle. It goes from a breakout phase to a channel phase. Both are in a trend. And then the channel eventually evolves into a trading range, neutral. And then from there, it breaks out again in either direction. So it's either trending or in a trading range. And when it's in a trading range, it turns into a trend. And when it's in a trend, it turns into a trading range. So why are breakouts difficult? Remember, I said all types of trading are difficult. You got breakouts, and then channels, and then trading ranges. Well, in breakouts, let's say you got a huge bear breakout, the stop goes above the top of the bar, so the risk is very big. You have to think very quickly because the market is moving very fast. you have to adjust the size of your position because your risk is now very large. You have to calculate how big your risk is and then reduce the position appropriately. So you have to be constantly adjusting the size of your position. You're also adjusting the size of your risk and your reward. And the fast adjustments are scary and difficult. You have to do them correctly. Although the probability of profit is very high, there's a sense of urgency, and that makes traders feel uncomfortable, and it often paralyzes them and prevents them from taking trades. Again, high risk. If you have a huge breakout, the stop goes below the bottom of the breakout in a bull breakout. In a bear breakout, it goes above the top of the breakout bar or bars, and it's far away. Traders always want to pull back so that the risk will be smaller. So let's say it's a bull trend and it's going up and up and up and up. Traders say, well, I don't want to risk all the way to the bottom of that bar, so I'll wait for a pullback, and then I'll risk to the bottom of the pullback when I buy. The problem is everyone knows that, and the trend will just keep going up and up and up and up, and it'll go very, very far before the pullback ever comes. And the result is the beginners will miss all of the breakout phase of the trend, which is the fastest, biggest part of the trend. Reversals are also very difficult. Okay? A reversal is a breakout or it leads to a breakout. So let's say you have a bull trend and the market's reversing. It either reverses with a breakout or it leads to a breakout. And the reversals usually look unconvincing. The probability just doesn't look good. It doesn't look good until the market has gone very far. In other words, until it has a big breakout. And by then you've already missed a big chunk of the move, and then you have the problems of dealing with a breakout. Channels are difficult. So after you get that strong bull breakout, the market then enters a channel phase. You start to have pullbacks. And when it's starting to have pullbacks, you look at it and you say, well, I don't know, it looks like it's trying to reverse. I don't want to be buying here. So traders end up getting trapped out. When you do have that little pullback, it'll start to look like, maybe this is not a pullback, maybe this is a reversal. So the beginners end up not buying the pullback because they feel that the pullback, even though the risk is much less, the probability is way too low. They see the pullback as a possible reversal rather than a pause in the trend. Remember, channels evolve into trading ranges, and if the market is now in a trading range, the probability is very low to buy at the top of it and very low to sell at the bottom of it. And also the risk is greater. So if you're buying at the top of a trading range, you're betting that the market has converted into a trend, and your stop is way at the bottom of the trading range. So you have a very big risk. Trading ranges always look like they're breaking out. You always have strong bull spikes to the top, and it looks like it's going to break out. Strong bear spikes to the bottom, and it looks like it breaks out. But the breakouts, 80% of them fail. Okay? The reversals at the top of the range don't quite look good. The reversals at the bottom of the range don't quite look good. So you have a strong bear spike, and it tries to reverse up. Traders are thinking, oh, such a strong bear spike, there should be a second leg down. So they don't want to buy near the bottom of the range. They think the probability is too low. Okay? It's better to scalp in a trading range, and you need high probabilities when scalping. So you have to wait for higher probabilities when the market's in a trading range. Sometimes you can get a very strong reversal bar at the bottom of the range or top of the range. That's higher probability. Or you can wait for a second entry, like a little double bottom at the bottom of the range or a little double top at the top of the range. Okay, what is the directional probability of an equidistant move? Well, it's the answer to this question. At any given moment, what are the odds that the market will move up one tick before it moves down one tick? What are the odds that it will move up 3 ticks before moving down 3 ticks? Okay? Equidistant move. In other words, 1 tick up or 1 tick down. 15 ticks up, 15 ticks down. Okay? What's the probability that it will move in one direction versus the other that same number of ticks? Most of the time, it's 50-50. Most of the time, there's a 50-50 chance the market will move up 2 or 3 ticks before it moves down 2 or 3 ticks. It'll move up 2 or 3 points before it moves down 2 or 3 points. Sometimes the probability is 60% or better, and when it is, you have an edge. But edges are fleeting, so you have to act quickly. For example, in a strong bull trend, the probability of the market rising 6 points or more in the E-mini before hitting a 2-point stop, it can quickly be 70% or higher, right? But it won't last long. So if you see that setup, you got to take the trade. Okay? When you're in here's an example of a strong bear trend, right? These 4 charts are the same chart, and they show what happens at different times of entry. Let's say you took the short right here, okay? The signal bar is 5 ticks, you have a 5 tick tall bear spike, right? The height of the body to the close of the body, okay? What's the chance that the market will go up 5 ticks before it goes down 5 ticks? Not much. It's probably going to go down 5 ticks, all right? So 5 tick measured move down here. If you entered on the close of this bar right here, okay, now the bear spike is 10 ticks tall, right? It's a bear trend, probably a bear trend. So the math is probably better than 50-50 that it's going to fall 10 ticks before it hits a protective stop above the top of the spike, right? So if you short here, your stop probably would be above the top of the spike, about 10 ticks up. So you're betting that it's probably going to fall 10 ticks before it goes up 10 ticks. Okay, let's say you sold the close of this bar. The spike is now 16 ticks tall, 4 ticks big. The probability is higher at this point that there will be good follow-through selling. Your stop is above the top of the bar, right? So at this instant, you're risking 16 ticks on a trade that probably will work, certainly at least 50-50. Your target at this point would be at least a 16-tick measured move. Let's say you entered a bar later over here, right? At this point, you'd have to risk 19 ticks. An equidistant move is down here, and your probability is higher than 50% since you're in a bear trend. It might be 60%. So as the spike grows from a 1-bar spike to a 3-bar spike to a 4-bar spike, and it's in a trend, the target also grows because you base your target upon your risk. You want to target at least as great as your risk. So here, if your risk is 16 ticks, let's say you enter at this instant, you have to go for a target that's at least 16 ticks. Here, you have a 19-tick target, 19-tick risk, but that's great for the traders who entered way back up here when the risk was just 5 ticks. So those traders, they're actually only risking 5 ticks. They shorted here, their stop is here. So at this instant, they're risking 5 ticks, yet when the market is here, they have probably a 50 to 60% chance of making 19 more ticks beyond where the market is at this instant. So you want to enter as early as you can and adjust your target as the size of the spike grows. And you can end up with a reward that's many times greater than your risk. So the traders who entered early, if they entered here or if they entered here, now have a target way down here several times greater than their risk. And they have better than a 50-50 chance of achieving their target. A trading range, what's the directional probability of a reversal going 4 points or more before hitting a 2-point stop? So let's say you're in a trading range that's 5 or 6 points tall, and you have to risk, and you're shorting at the top, and you have to risk 2 points. What's the probability of the market going 4 points in your direction? And sometimes can be actually 70% or more. So shorting at the top of a trading range can have a very strong trader's equation. You might be just risking 2 points to above the top of your bear signal bar, and yet your target might be the bottom of the range, which could be 4 points or more away. And you could end up sometimes having a very high probability of getting a reward that is twice the size of your risk. Here's a trading range, okay? The top half is in blue, the bottom half is in green. You want to buy low, you want to buy in the green half. You want to sell high, you want to be selling in the top half, right? And in the top half, the probability of profit is higher for the bears, so it's better to short. In the bottom half, the probability of making a profitable trade is better for the bulls, and it's better to only be buying. In the middle of the trading range, the probability for both the bears and the bulls is 50%. and that makes it tough to make a profitable trade, because with a 50% probability you need a reward twice the size of your risk, and it's very hard to do that because you need a certain risk size, and there may not be enough room left to the edge of the trading range for you to make a reward twice the size of your risk. If you short near the top, you certainly can get a reward twice your risk. If you buy near the bottom, you certainly can get a reward twice your risk. Okay, let's talk about high probability trades near the top or bottom of the trading range. If it's high probability in the E-mini and you're risking 2 points, all you have to do is go for a target of 2 points. So if you're buying near the bottom and you're using a 2-point stop, and you're probably a 60% certain of making a profit because you're buying at the bottom of a range, you only have to go for a reward that's equal to your risk or 2 points. In the middle of the range, 50-50, it's usually better not to take any trades. At the bottom of the range, you probably do have a 60% chance of the market going up 2 points before going down 2 points. At the top of the range, you probably have a 60% chance of the market going down 2 points before going up 2 points. Here, if you shorted below this bear bar, your risk is 1 tick above the bar to 1 tick below the bar where you entered, and you're shorting a bear bar, a second entry short at the top of the range, probably a 60% chance of making as many ticks as you had to risk, and that would be a positive trader's equation. And this is the end of the module on probability and the trader's equation. This is Al Brooks, and this is my price action trading course. This module is on swinging and scalping. A swing trade, it's any trade where the reward is at least twice as big as the risk. It's as simple as that. Anytime you're going for a reward that's twice as big as your risk, I consider it a swing. If you go for a trade where the reward is less than twice the risk, I call it a scalp. In general, with a swing trade, traders are expecting at least 2 legs in their direction. So if they're buying for a swing up, they're expecting at least 2 legs, maybe many more legs, but at least 2. For a scalp, you're usually just looking for 1 quick leg. So for example, if there's a bull spike and then a pullback and then you're buying for a scalp, you're just buying for 1 more push up. Even though the market may go much further, you're buying just for a quick scalp, a quick move. In general, scalping looks extremely easy to do, but it's extremely difficult to do profitably, and beginners should not be looking to scalp. Beginners should be looking for swing trades. I have a section, a module later on that talks about what beginners should do and how to trade, how to start out. Here's an example. If your stop is 20 ticks away from your entry price, then the risk is 20 ticks. If you're going for a reward that's 40 ticks or more, the trade's a swing. If you're going for a reward that's less than 40 ticks, the trade is a scalp. As I said, scalpers are just looking for a quick move. They usually don't allow pullbacks, or they'll only allow very small pullbacks. Swing traders will allow 1 pullback beyond their entry price, but if the trend resumes in their direction, they'll have a break-even stop, and they will not let the market come back to their entry price a second time. And in general, they're looking for at least 2 legs. Okay, here we have a possible higher high major trend reversal, or a possible trading range top. A swing trader, if he shorted here, taking this second entry high, second entry short at the high, he would allow the market to come back to his entry price here. However, once the market started down again, he would place his stop at break even, and he would exit if the market came back to his entry price a second time. A scalper on this trade in the E-mini had to risk a total of 5 ticks, 1 tick above the signal bar for his stop, 1 tick below for his entry price, so he might get out at a 5-tick profit. Again, beginners should swing rather than scalp, and when scalping, If an experienced trader is scalping, in general, it's far better to be scalping with in the direction of the trend. If you have a very broad bull channel, for example, a very weak trend, you can scalp in both directions. Beginners, however, they should never scalp against a weak trend. So if the market's in a weak bull channel, beginners should only, if they're looking to scalp, they should only be taking the buy signals and not the sell signals. When there's a pretty strong trend, traders should not be scalping. Trends are always trying to reverse. But almost all reversals end up as flags in the direction of the trend. So here we have a bear trend, and we have lots of great reversal bars. Here's a bull reversal bar. Here are a pair of bull bars closing on their high. Here is a 2-bar reversal after an II final flag. None of these trades was a profitable scalp. Here's the price scale on the right. All right. If you're going for a reward at least as big as your risk or twice as big as your risk, and it's virtually impossible to make money scalping when the market is fairly strongly down. So here the channel is pretty tight going down, not big swings, so traders should not be looking to buy. Every one of these reversal attempts, as good as they looked at the time they formed, they became simply bear flags, failing at the moving average and leading to another leg down. This is what you should be doing when you see a bear trend. Even a channel with some swings up, you should concentrate on taking the shorts. So every time it gets up to near the moving average, you look to go short below bear bars. So all of these scalps were profitable, whereas very few of the buy scalps were profitable. So beginners for sure should only take the shorts. As soon as they diagnose the market as being in a bear trend, here it's a bear trend and it's a bear channel, so it's a relatively weak trend, you still should only trade in the direction of the trend, which means looking to short. Beginners love to scalp against the trend. They believe that the correction is overdue and that the trend can't go much further, and they're so afraid of losing that they only consider risk in the trader's equation, right? And trader's equation has 3 variables: probability, risk, and reward. All they do is see that they're, for example, in that bear trend, all they see is that they're buying above a small bull signal bar, and their risk is small. It's only to the bottom side of the bar. However, they're ignoring the reality that the probability is low and that the reward is also too small in the face of that low probability to make a profit, and they'll slowly watch their account melt away. Again, a terrible trader's equation. When the probability is small and each loss is greater than each winner, you'll bleed to death from 1,000 paper cuts. So yes, each loss will be small, and you'll say, well, I'm not losing all that much. But if you keep losing, and losing, those small losses add up to a lot. Small risk, tight stop for a scalp, all right? You need a high probability trade. This is the key to scalping. If you're going for a small reward, let's say reward equal to your risk or twice as big as your risk, okay, you need a high probability trade to be profitable. Can scalping be profitable? Sure it can be. High frequency trading firms scalp all the time, and a lot of them make money. Not all of them. A lot of them lose money, but a lot of them make money. What's the easiest way to make money trading scalps? First of all, selectively picking out the very best trades and using big volume, or as big as you possibly can use. However, the reality is when you're taking those best trades, most of them end up being swings. So you'd make more money by swinging rather than scalping. So if you have the ability to spot those best trades, why scalp them? Just go ahead and swing them. Okay, at the other extreme, impossible for most traders, instead of swinging, is extreme scalping. All right, you can see the module on extreme scalping. High frequency trading firms, they're scalpers, and they're using computers to generate the signals, and they're taking thousands of trades a day, going for very small profits. And because the computers are making the trades and making the decisions, they don't get tired, and they take every signal exactly according to plan. So they can have a relatively low probability, let's say 55% probability, maybe a risk as big as their reward, and if they do it thousands of times a day and do it exactly correctly every time, they can make money. However, it's extremely difficult for humans to do that when the margin of error is so small. Also, high-frequency trading firms have minimum commissions. Okay, when you're talking about risk, there are two important types of risk to consider. There's the initial risk, the distance of your initial protective stop, and then there's the actual risk, right? So the initial risk is the distance to your original stop, from your entry price to the stop. Your actual risk is once the trade starts to go your way, you look back to see how many ticks the market went against you before it went your direction. Your actual risk was one tick more than that number. In other words, let's say you short and the market pulls back a little bit after you enter and then it turns down again. For you to not have been stopped out, you can look back and calculate how many ticks the market went against you, and had your stop been one tick more than that, you would not have been stopped out. That is your actual risk. And you can use your actual risk for determining what your profit target should be. So you can convert a swing trade into a scalp trade. Okay, most swing trades have low probability, but if the market starts to go your way and you discover that your actual risk is very small, you can convert some of your swing to a scalp and still have a sound mathematical equation, trader's equation. But you got to make sure that if you do go for a scalp, a small reward, that your reward is at least as big as your risk. Okay, going back to what I was saying on how to calculate actual risk, this is what you do. You count the number of ticks that the market moved against you before it went your way. So once the market starts to go your way again, you look at how many ticks the market went against you, and one tick more than that was your actual risk. So you can reduce your target to your actual risk, and you can convert some or all of your swing into a scalp and have a positive trader's equation. So here's an example. If traders bought this higher low major trend reversal, a bear trend, trend line break, small higher low, if they bought this going for a swing and they entered and the market went up pretty quickly, they could look back and say, my actual risk was one tick below the low of this bar, my actual risk is small, 4 ticks, therefore I can scalp out with 4 ticks. If they took it for a swing, their swing stop, their initial risk was below the bottom of this spike, maybe below the actual bottom of the trend, more likely below the bottom of the spike. So when they bought here for a swing, they initially put their stop down here. However, once the market started to turn up, they discovered that their actual risk was just one tick below their entry bar or one tick below the signal bar, and it was small. So they could take out part or all of their trade as a scalp. And that's the end of my module on swinging and scalping. This is Al Brooks, and this is my price action trading course. The current module has to do with orders. For entry orders, beginners should only be entering on stops. You want the trend to be sweeping you into the trade. You want to be carried in by the momentum, even if it's only one tick in the direction of the trend. So how to enter on a stop? You're buying or selling the breakout of the prior bar. It's a great way to trade when there are swings or trends, but it's a terrible way to trade in the market when the market is in a tight sideways market. In other words, a tight trading range. So if the market's in a tight trading range, don't use stop entries, and beginners, in fact, should not trade at all. Experienced traders can also enter with market orders, for example, during very strong breakouts, and with limit orders, either during strong breakouts or in trading ranges, including very tight trading ranges. So, for example, if there's a very tight trading range and the market falls below the low of the prior bar, experienced traders can buy at the low of the prior bar, looking for a scalp up. Remember, when you're entering with a limit order, you're entering in the direction that is opposite to the most recent tick. So if you're buying with a limit order, you're buying as the market is falling. So you have to know what you're doing in terms of reading price action if you're going to be buying a falling market. For example, it's buying below the low of the prior bar or selling above the high of the prior bar. So let's say the prior bar goes up and you sell one tick above the high of the bar, or at the high, you place a limit order at the high of the bar to go short. You're selling as the market's going above the high of the prior bar. So you're betting that the breakout will fail. And you should only be doing that if you're very confident with your ability to read charts. Every bar with a tail is a failed breakout attempt. In other words, a trading range type bar, right? If lots of bars have tails, it's better to bet on failed breakouts. So if the market has lots of bars with tails, that means every time the market goes up, it finds sellers. Every time it goes down, it finds buyers. So if you're in a sideways market with lots of tails, you don't want to be entering with stops. Instead of betting that the breakout will have follow through, in other words, for example, buying with a stop above the high of the prior bar, it's better to bet that the breakout will fail and go the opposite direction. So experienced traders, rather than buying on a stop at one tick a buy above the high of the prior bar, they'll place a limit order at the high of the prior bar to go short, betting that the breakout will fail. Okay, so if most of the bars have tails and there's a lot of overlap, the breakouts will fail. So it's a terrible environment for stop entries and a very good environment for limit order entries. Limit order entries are bets that breakouts will fail and that the market will reverse. So should you be using a stop order or a limit order to enter a trade? A stop order is betting on a successful breakout. A limit order is betting that the breakout will fail. So you have to look at the price action. If the market's having big swings up and down with very little overlap between the bars, and you have consecutive trend bars up and down, that's a great environment for stop orders. If you sell one tick below the low of this bear bar, it's a good bet that the market will go down far enough for a profitable trade. If you buy one tick above the high of this bull bar, it's a good bet that the momentum will continue up and you'll make a profit. So when you start to see consecutive trend bars, not much overlap, and pretty big swings, that's a very good environment for stop orders. It's also a good environment for market orders. During this bull spike or this bull spike, you can buy at the market, betting the market will continue. During this bear spike, it's a good market for entering on just at the market, betting the market will continue down. However, when the market transitions into this, lots of sideways bars, lots of overlapping bars, lots of big tails, lots of reversals, bear bar, bull bar, bear bar, bull bar, it's a terrible environment for stop orders. Breakouts are going to fail. If it goes below the low of the prior bar, it's probably going to go up. If it goes above the high of the prior bar, it's probably going to go down. So when you see a market that's starting to look like this, don't enter with stop orders. This is for more experienced traders, and they'll be trading with limit orders. They'll be buying with limit orders at the low of the prior bar and selling with limit orders above the high of the prior bar, looking for scalps. When you're entering with a stop order, for example, if you're going to buy on a stop, you place a buy stop order one tick above the high of the prior bar. That prior bar is the signal bar, and if you get filled, the bar in which you get filled is your entry bar. Again, you want to be swept into the trade by the market going in your direction. For example, here's a 2-bar reversal, a bear bar, a bull bar about equally strong, closing near its high. If you were buying above this signal bar, as soon as this bar closed, you place a buy stop at 1 tick above its high, hoping that the market will go above the high of that bar, hit your buy stop, and fill you. And that's what took place over here. This is the bar when you entered the trade, so this is your entry bar. The initial protective stop, 1 tick below the signal bar, and the profit target always at a minimum is at least as large as your stop, preferably 2 times as large as your stop. So for example, your protective stop is 1 tick below the signal bar. Your entry price is 1 tick above the signal bar. A minimum objective would be a measured move up based upon the height of your risk. All right, so this is how much you risked, and this is a measured move up equal to the distance between the 2 red bars, and that would be the minimum profit target that anyone should ever try to get. If you're trying to enter with a stop order and you're doubtful about whether or not the signal or setup is strong enough, don't take it. Right? Wait for a second or third signal and then consider taking the trade. So it's, when in doubt, always stay out. So when in doubt, stay out and wait for a second signal or a third signal. For example, if you see this failed breakout, we have a trading range, a strong breakout, and we see a bull reversal bar for a possible long, and you look at it and you say, well, it's only a 1 tick body, and it's after 3 pretty good bear bars, and these 2 are especially strong, closing on their low tick. I don't want to buy that. I'll wait for a second signal. Here, the market broke to the downside, and again, we got a similar bull bar. At that point, you can consider buying. Here, you could say, well, I want to sell. We're pulling back to the moving average, but the signal bar is small compared to the bull bar, and the bull bar opened on its low tick, closed right on its high tick, so it's very strong. I'll wait to see if there's a second signal bar, and I'll take the second signal. Here, the market tried to go up a second time, and again had a bear bar closing on its low. So shorting 1 tick below the low of that bar would be your second signal, and you would have been filled over here. Over here, let's say the market's going up, and you did not want to short this after 5 or 6 consecutive bull bars and a weak signal bar, so you don't short that. You wait for a second signal. You can argue, well, I don't know, this is a lower low. Maybe I'll wait for a second push up, second new high. Here we got a second push up. Maybe you'll short over here. There's a second entry short. Here's the first entry long after a 7-bar bear micro channel, 7 or 8 bars down. Here's the second signal. Again, not a great signal bar, but at least it's a second signal, and that increases the probability of success. When you're entering with limit orders, you're trading counter trend, right? If you're entering with a limit order to sell, the market has to go up for you to get filled. If you're placing a buy limit order, the market has to go down for you to get filled. So you're buying a falling market or you're selling a rising market. So you're trading counter trend, betting that the breakout above or below the prior bar will fail. Okay, if you're trading during a trend, during a breakout, betting that a reversal attempt will fail is much better, right? So if you're in a strong bull breakout, you don't want to be selling above the highs of bars. However, if you get 3 or 4 consecutive bull bars and then a bear reversal bar, you can place a limit order at the bottom of that bear bar, because that bear bar is an attempt to reverse a strong trend, and most reversal attempts in trends fail. So you can take that bet. So you can buy with a limit order below the low of that reversal bar. So when you're entering with a limit order, you're fading a breakout, you're betting on a reversal. When the market is at the top or bottom of a trading range, chances are any breakout attempt is going to fail. So if the market races up to the top of the trading range, has a small bull flag, chances are the breakout from that bull flag will fail. If the signal is weak enough, experienced traders will place a limit order above the high of the prior bar to go short, betting that the market will not break out. When a channel is weakening and evolving into a trading range, let's say you have a bear channel and you're starting to get a lot of buying pressure and you have a bear flag right at the bottom, experienced traders will place a limit order to buy at the low of the prior bar, betting that the next breakout will fail. So when the market's at the top of a trading range, experienced traders will sell above the high of a weak buy signal bar. And they'll also sell above prior highs, betting that breakouts will fail. And that's the correct assumption. When the market's at a bottom of a trading range, traders will buy below the low of a weak sell signal bar. If it's a weak sell signal at the bottom of a trading range, it probably will fail and the market will probably turn up. So experienced traders will buy below that bear signal bar, betting that the market will reverse. If the market is falling below a prior low at the bottom of a trading range, traders will also buy on a limit order there at that prior low, betting that the breakout will fail. So here's an example. Market's in a trading range, and we're starting to get very two-sided trading at the top of the trading range. Experienced traders will not buy above this bull bar. They'll look at this as a trading range and expect that the market will reverse down to the bottom of the range. So they'll, instead of buying at one tick above the high of this bar, they'll place a limit order at the high of the bar, betting that if the market goes above the high of the bar, their limit order will be filled and the attempt to break out will fail and the market will fall. They might use a protective stop based on a measured move, maybe based on the height of their signal bar. They may place a protective stop above the top of the swing high, especially since it had 3 pushes up. And minimum target would be, if they were very confident about the trade, they can go for a reward equal to their risk. If they're less confident, or if they think the market is going to trade down low, maybe they'll go for a profit of at least twice their risk. So if they sold here and their stop is 1 tick above the high of the swing, and they go for a profit target twice their risk, they would get out down here. They may try to get out down in the area of this higher low, or maybe even the low of the trading range. Top of a trading range, do not look to buy below the low of the prior bar. If this was a strong bull trend, you'd say, wow, it's going to go up a lot higher. Therefore, I'm going to be clever, and I'll place a limit order to buy 1 tick. I'll buy at the low of this bar, betting that the market will go higher. In general, when the market's in a trading range, you want to buy low, sell high. So you should only be looking to sell, and even trying to be clever, buying with a limit order at the bottom of the bar, betting that you're going to be getting an early entry into a big move up. That's not what to do. In a trading range, you buy low, sell high. Where high, you only look to sell. So you're not looking to buy with a limit order below this bar. You're looking to sell with a limit order at the high of this bar. And again, only experienced traders should be entering with limit orders, because I think it's too difficult emotionally for beginners to be buying when the market looks like this. The market's going up for 10 or 15 bars. It's very difficult for beginners to be selling when the market looks like this. It's going up for 10 or 15 bars, and you're betting that the rally is going to fail. I think that's just too difficult for beginners to assess, make that judgment, and it's also too difficult for them to manage the trade. It's too stressful. Again, the market's in a trading range. You want to buy low, sell high, and scalp. We're low. Okay. You want a reward at least as large as your risk, but if the target is just too small, go for a bigger go for a bigger target. So, for example, let's say you placed a limit order to buy the low of the prior bar, betting that this 1 bar final flag this 1 bar bear flag will fail, and there'll be buyers below, and the market will turn up. Okay, so your stop. Let's say your stop is below the low of the bear. So you enter here, your stop is 1 tick below, which is here. So your risk is actually very small. You could say, well, I'll get out with one time my risk. When the risk is small, it's usually better to go for more than just one time your initial risk. So at a minimum, I'd go for twice my initial risk. So if you bought at the low of this bar and you risked to one tick below this bar, the low of the bear, exiting twice your risk would be right here. And you can see lots of traders did exactly that because we got a tail there. Obviously, it's also a test of the moving average and a failed breakout above this prior bull reversal bar, right? But clearly a lot of traders exited here. And, I mentioned in an earlier module that when the market's starting to try to reverse, for example, here it's in a bear trend and you get a decent looking bull reversal bar, traders will start to scale in and they'll add on lower, and then they'll try to get out around the original entry price. So if they bought, let's say, this close or right around here, and the market sold off, maybe they bought more here, they'll get out of everything around their original entry price. And that's part of the reason for that tail. Okay, let's say you have a channel and it's beginning to weaken and turn into a trading range. Traders are going to look to fade breakouts from weak signals. So if you have a bull channel that's starting to get a lot of two-sided trading and you're now near the top of the channel and there's a buy signal, a small bull flag, traders, and it's weak, let's say a doji bar, traders will bet that it will fail and that the market will start to sell off and transition into a trading range. Again, this is only for more experienced traders. So if a channel looks like it's evolving into a trading range, and let's say it's a bull channel and you're at the top, traders will place limit orders at the high of the prior bar to go short, betting that if the market goes above the high of the prior bar, that breakout attempt will fail. In a weak bear channel, it's trading down and you get a small bear flag, traders will buy with a limit order at the low of the prior bar, the signal bar for the short, betting that the short will fail. So here's an example. Obviously a very weak bull trend, lots of prominent tails, not much in terms of consecutive bull bars, and now we're up at the high of the day, right? So traders see this bear inside bar and say, well, that's a pullback, it's a breakout pullback buy. However, we're at new highs on the day, right around the prior high of the day. The trend up is very weak. I'm going to start scaling into shorts. So instead of placing a buy stop at one tick above the high of this inside bar, expecting more up, traders instead will place a limit order to go short exactly at the high of that bar, betting that the market will go down. When the bar closes, they can calculate a measured move up and maybe use that or a tick or so above that for their protective stop. Once the market started to go down, they could then go for a reward equal to at least their risk. So the minimum profit target is at least their risk. What about when you're in a strong bull trend? Does it make sense to buy with a limit order? Absolutely. Okay. The market is turning up here. We gapped up, we pulled back, and we had a strong bull reversal bar. We have another bull reversal bar. And now we're breaking out to a new high of the day, and the market's closing on its very high tick. Most traders would look at this and say, wow, it's a bull trend day. We're probably going higher. What a lot of traders will do is, as soon as they see that strong close, they'll quickly place a limit order at the price of that close to buy. So if the market ticks one tick below, they'll get filled on along. And that's exactly what happened. The next bar, it ticked one tick below that close, and it went up. And it went up because a lot of traders had buy limit orders and market orders as soon as that bar closed. Where's their initial stop? Probably at the bottom of this bar, since this is such a strong breakout bar. So now they know their risk. The probability is high, 60%. They feel confident the market's going higher. So they can go for a reward equal to their risk. So they just find out where the measured move is from their protective stop. It's right here. And they'll scalp out part or all of their trade. On a swing trade, on a strong bull trend like this, it's probably better to swing. But the swing stop stays down here or down here. So if you're going for a swing, the stop on the swing portion is below here or below the bottom of the bull spike. On the scalp portion, you can get out right there, based on a measured move from the bottom of this bull bar. Okay, here's that same very strong bull trend. You feel confident that the market is in a strong bull trend. It probably will get a second leg up. So what you can do is bet that every attempt to reverse the market will fail. And how do you place that bet? You place a limit order at the low of the prior bar to go long, to buy, a buy limit order. Your initial stop is probably below the bottom of the bull spike, maybe below the bottom of the breakout bar. But in any case, it's a reasonable trade to buy with limit orders at the bottom of bars, betting that each attempt to sell off will fail. We have another bull spike, small pullback after the breakout. Traders, and here's the reversal attempt. So we have a bull breakout. Here's the reversal attempt, a very weak looking reversal attempt. So the reversal attempt will probably fail. Traders will place a limit order at the low of that bear signal bar, betting that the bear signal will fail. So they get long at that low for a scalp up or a swing. If the market is breaking out and you're extremely eager to get in, let's say it's a 5-minute chart and it's breaking out, and you want to get in before the bar closes because you don't want the bar to get too big. Remember, your stop would be beyond the bar. So if it's a bull trend, for example, the stop, and you wait for the bar to close, your stop is below the low of the bar. And if it's a big bar, it's far away. So a lot of traders don't want to risk that much. Plus, they're eager to get in as soon as possible. They can either buy at the market, or they can look at a smaller time frame chart, like a 1-minute chart. If the 1-minute chart has 4 or 5 consecutive good bull bars, let's say in a bull breakout, simply buy at the market and place a limit order place a stop order below the bottom of the spike. Alternatively, instead of buying at the market, you can start placing limit orders at the low of the prior bar, right? Betting that any reversal attempt will fail. Again, putting your protective stop at the bottom of the spike. So here's an example. 5-minute chart on the left, 1-minute chart on the right. Over here, you see the market is probably becoming always in long. By the close of this bar, it is always in long. You could wait for the bar to close and buy at the market. Maybe put a stop below the low of the bar or a stop below the bottom of the spike. Or you can look to the 1-minute chart. And at this point, you see 1, 2, 3, 4 bull bars, right? 4 consecutive bull bars. The context is good for a move up. You're eager to get long. Simply buy at the market on the 1-minute chart and put a stop below the bottom of the most recent bull spike. So below this bear bar, below that bull bar, maybe even simply below this 1-minute bull bar. Also, you can look to buy the first pullback, betting that the first attempt to reverse will fail. So you place a limit order to buy more at the low of this bar, did not get filled. You place a limit order to buy at the low of this bar, not get filled. Finally, you do get filled. Finally, there's a pullback. The market fell below the low of that bar, and your limit order to go long was filled. And then you can go back to the 5-minute chart to manage your trade. So this long entry corresponds probably to around the close of this doji bar. And that is the end of my module on orders.